How's it going, everyone? Welcome back to my YouTube channel, Intelligent Investing, where we talk everything stock market investing. Now for today's video, I'd like to take a look at 5 high dividend yielding stocks, some of which I own and some that I hope to add to my portfolio in the near future. Before we do jump into the video, please consider subscribing to the channel, leave the video a like if you do like this type of content, as I'll be making 2 to 3 videos a week, and also comment down below your favorite company with a high dividend yield. So the first company we'll be taking a look at is Enbridge Incorporated, which is a Canadian multinational energy transportation company based out of Western Canada, and it focuses primarily on the transportation, distribution, and generation of energy, primarily in North America. Now taking a look at their 5-year stock chart, they do go up and down based on the price of oil usually. So in 2016 and 2018, when the price of oil was trading well below its normal levels, as well as now during the pandemic, their stock price has taken a big hit. However, over the years it has always rebounded, and it usually trades between $50 to $60. So at a price of about $40, I think it's a really good buy because you will also, along with the dividends, be getting a nice capital return. So taking a look at Enbridge's dividend yield, they have a yield of 7.33%, which is very nice and high, and a dividend safety of 57, which is borderline safe, and their dividend growth has been 10% in just this last year. And taking a look at their streak, they have a streak of 25 plus years uninterrupted dividend streak where they've been paying out without cutting it at all, and their dividend growth streak has been 24 years of consecutive increases. So this is really nice. They're paying out about $3.20 this year per share to investors. Personally, I am invested in Enbridge. I own 33 shares, and I'll be receiving a nice dividend on June 1st of 80 cents per share. Now taking a look at their balance sheet, Enbridge has 8.8 billion in total current assets, as well as 154 billion in total non-current assets, and in total it comes out to 163 billion. For their total current liabilities, they're at 16 billion, so about double their total current assets, which is kind of a bad thing and something to keep in mind when buying into this company. And their total liabilities overall are 93.8 billion. So they do have about double the assets. However, their current assets are about half less than their liabilities, which is definitely of concern. But with their dividend streak of 25 years, I'm not worried that they will ever cut this dividend, and I hope to keep increasing my position in Enbridge to keep receiving this nice dividend. The second company we'll be taking a look at is Altria Group, which is an American corporation and one of the largest producers and marketers of tobacco, cigarettes, and related products. So personally, I am not invested in Altria Group, but I do want to open up a position in my portfolio because I do think the long-term benefits are big, and as well they pay a very large dividend. So taking a look at their dividend yield, it's about 9% at 8.91%. They have a borderline safe dividend of 5.55, and their dividend growth has been 9% this last year, which is very fast. So some of their biggest products are cigarettes, obviously, Marlboro, Black and Mild, and they've started diversifying very nicely in the past many years because, as we know, cigarette smoking has become less big in the world because of the health problems that come with it. So they diversified by investing in the Kronos Group, which is an emerging global cannabinoid company. As well, they have a large investment in InBev, which is a global beer industry leader, as well as they have a big investment in a top 10 domestic wine producer. So that's very good to see them diversifying. Now, looking at their dividend payout, they have an uninterrupted dividend streak of 50 plus years, which makes them a dividend king, and their growth has been for 50 years of consecutive increases, which is really good. So even during the Great Recession, we can see they did lower their dividend, but that has gone back now, and they never cut it, which is really important. So taking a look at their balance sheet now, Altria has about 4.8 billion in current assets, and total assets are 49 billion, and their total current liabilities are 8 billion, and their total liabilities are 42.9 billion. So This is also not the greatest balance sheet in the world, similar to Enbridge's, as their total current liabilities are about double the total current assets. However, I don't think this is a big problem in terms of dividend safety because they have been paying it out for 50 years, and I don't think they'll be stopping anytime soon. The third company we'll be taking a look at is Exxon Mobil, which is an American multinational oil and gas corporation. So I think this is either the biggest or the second biggest oil and gas company in the world. And if we take a look at their 5-year stock chart, it hasn't been pretty. They are down about 47%. And in the past 6 months, from high to low, they've been down 55%, getting a nice bounce of 40% back. However, they are still very, very, very hit hard. As we know, the price of oil has gone negative in the past months, so they're not doing great. However, if we look at the max chart, this is a company that's fairly volatile over the years, and they go up and down, but they have always bounced back big. And seeing that they're at the price of $44.60, a price we haven't seen for ExxonMobil since like 2004, I think they're in a great position to be buying into. And I personally just purchased my first few shares in ExxonMobil, and I'm very excited for the potential growth and the dividend payout. So if we take a look, ExxonMobil has a dividend yield of 7.8%, which is very high. Also a dividend safety of 55, which is borderline safe, same as the other two companies we mentioned. And their dividend growth is 6% last year. This is a massive company that has a $189 billion market cap. And taking a look at some of their things they're involved in, their earnings are 50% from upstream, so explores for, develops, and produces oil and gas around the world. Crude oil and natural gas liquids account for 60% of Exxon's production, with natural gas driving the remaining 40%. And then 28% of earnings are from downstream, so Exxon's global network of manufacturing plants, refineries, transportation systems, and distribution centers provides fuels, lubricants, and other products to customers. And finally, 22% of earnings are chemicals. They manufacture and market petrochemicals and a wide variety of special chemical products used in packaging for materials, plastic bottles, vehicle parts, synthetic rubber, and solvents. So not all their earnings are coming from oil directly. Now let's take a look at their dividend. So they have an uninterrupted dividend streak of 37 plus years without dividend cuts, which is really good. A company like Shell, for example, another oil and gas company, has cut their dividend just a couple months ago, and their dividend growth is 37 years of consecutive increases. So they're paying out almost $3.50 per share, which is really quite nice. Now let's take a look at their balance sheet. So their total current assets are sitting at 50 billion. Their total assets are 362 billion, while their total current liabilities are 63 billion. So as well, their current liabilities are slightly higher than the total current assets, and their total liabilities are 163 billion. So their total assets about double their total liabilities. However, in the short term, it might seem a problem that they do have less current assets. However, I do think this is still a great buy because, simply put, their stock price has dropped so much in the past year, and we will see a rebound in oil, which means we'll see a rebound in Exxon's earnings, and their stock price will go back hopefully to the 60-70 range. So the fourth company I'd like to take a look at is Realty Income Corporation. So far we've had two companies that are involved in the oil and gas business, one tobacco company, and now this is a REIT. So they're involved in real estate. And taking a look at their 5-year stock chart, you can see that they have very steady growth. They've grown about 81%, which is quite nice. However, in the past 6 months, due to this pandemic situation, from highs to lows, they've gone down almost 50%. And since then, they're back up about 22%, so that means they're about 27% still down. So it might seem like a very nice opportunity to buy into this stock. And now taking a look at their dividend, they have a yield of 5.36%, and it's very important to note that this company does pay out a monthly dividend, which is very nice to add to your portfolio. They have a dividend safety of 70, which is much safer than the other three companies I've mentioned so far. But with that being said, they do have a less consistent growth. The growth is about 3%, which is considered slow. With their recent earnings, they did report this statement that they reported 83% of rent was collected in April, which is not bad given the circumstances. April rent collection was better than expected and beat that of all other retail REITs we've studied. So they've been doing much better than many of the other REITs in the industry. Now taking a look at their dividend streak, they have a 25 plus year uninterrupted dividend streak, and their dividend growth streak is 25 years of consecutive increases, even though that increase is much smaller than the other three companies previously mentioned. So they pay out almost $3 per share. Now taking a look at their balance sheet, they have quite a nice balance sheet with 455 million in total current assets. Total assets are 18.5 billion. Total current liabilities 227 million, while total liabilities are at 8.7 billion. So if we take a close look, they have about double the total current assets over total current liabilities, and about double, more than double total assets over total liability. So they're in a very nice position, which makes sense why their dividend is safe. They won't be cutting that anytime soon, and we can expect growth over the coming years, both in the stock price and in the dividend yield. So I definitely do want to add this company to my portfolio, especially due to the monthly dividend payouts. And now the fifth and final stock is Pembina Pipeline. So Pembina Pipeline is a Canadian corporation that operates transportation and storage infrastructure delivering oil and natural gas to and from parts of Western Canada. There is also a natural gas processing business that takes place at the Cutbank complex. So this is a pipeline corporation, and if we take a look at their stock price over the past 5 years, they have shown pretty nice growth, about 33%, and since highs to lows from in the last month or two, they've gone about 68%, 69%, and since then they've bounced back to over 100%, which is absolutely huge. So a big reason to buy this company, not just for the growth, but the big dividend. And you can see they have a 6.47% dividend yield and a very, very safe dividend at 75. However, their dividend growth has been slow this year, and that's in part due to the current situation in the world. Taking a look at their dividend streaks, they have a 21-year uninterrupted dividend streak without dividend cuts, as well as dividend growth streak of 9 years consecutively, which is quite nice. So it doesn't grow as much as the other companies, but since they have been hit very hard by this current situation, and they are very low compared to where they have been at over the past 5 years, I think it's a very good company to buy, not only for the dividend, but also the capital gains that could be made from it. And let's take a look at their balance sheet. So their total current assets are 2.7 billion, while their total assets are 45.6 billion. Their total current liabilities are 4.9 billion, while their total liabilities are 32.6 billion. So another company that has more current liabilities than current assets. However, their total assets are much larger than their total liabilities. So I don't think the dividend is a problem. They'll be paying that out for another 25 years for sure, and with that growth is also nice. So with that being said, that'll about wrap up the video. Those are 5 high paying dividend stocks with about a dividend yield of 6 to 7, 8%, which are very nice to add to your portfolio. I do think that all these companies will show nice gains in the next coming years, as well as a growth in their dividend. So I personally will be investing in most of these companies, I think. And if you have made it until this point of the video, I'd like to thank you, and please do leave a like if you did enjoy this video. I'll be making many more like this, and please subscribe if you are new, and comment down below your favorite dividend stocks, and I'll see you in the next one.